There are three angles to the business. There's a high street retailer we all know and love that sells books and magazines as well as confectionery. But the more interesting part of the business is the travel side, where they have units in railway stations, airports, as well as a growing international business. So we think there's going to be a lot of growth in the international business, where we believe that they'll be able to grow their profits significantly over the next 3 years by opening more and more units in international airports in places like India and Australia. On our numbers, we think they'll be able to grow profits in this division by 34% a year for the next 3 years, as well as benefiting from a macroeconomic recovery in the UK. We're seeing better and better data coming in from airports and railway stations in terms of more people visiting them. There's a macro benefit in terms of lower oil prices. We suspect that this will benefit WH Smith's travel units quite a bit, so we're very positive on the stock. So WH Smith has about 155 units in international locations, and we think they'll be able to grow this significantly at a pace of 20 to 30 per year, as well as growing the profitability of the units, as this is still a very small part of their business. And the way they've gone about it is to operate the business as international franchises, so they'll find partners to put up the capital and they'll just take a royalty fee off the top of that. So we should see significant growth in this side of the business. WH Smith run a unique business model on the high street in the sense of they don't try and chase sales growth. They do operate in difficult categories in terms of books and reading materials that we know that people are buying less and less of in print format. So they have a unique model of focusing on getting a lot of cost savings out of the business. They've got a big program in terms of cost savings that they've achieved over the past 5 years, as well as setting ongoing targets for the next 3 years, which we think they're likely to beat. They're also very focused on driving store productivity. They've moved a lot of the categories away from lower margin things like CDs and DVDs, as well as some of the reading materials, into higher margin stationery, and as well as moving into sort of food on the go categories that have been performing very well over the past few years. So WH Smith have a lot of systems in place to where they can monitor sort of every single square foot of their real estate in the store, and they sort of actively monitor every single aisle, and they change the sort of store layout and shelf layouts twice a year to make sure that they're maximising the space on the high street. Another element of that is they've seen that some of their space could be more productive if they use the real estate better, and they got concessions from the post office. So there's over 100 post offices in WH Smith stores. There's over 20 Costa coffees in stores. So they're very much focused on achieving optimal space productivity. Because WH Smith has multiple angles to it, we value the business on a sum of the parts basis. We think the high street business, although is unlikely to see much sales growth, they should be able to drive profitability through cost savings as well as space management. So we value that at a discount to the UK sort of high street sector, and we value the international travel sector to its international peers like Dufry and World Duty Free, and doing that still leaves decent upside in the shares. We've got 12% upside to our current price target. WH Smith has a trading update on the 3rd of June, as well as full year results in October. So we believe those results will reflect improving profitability in the travel units as sort of cyclical demand picks up in the UK, as well as sort of ongoing structural growth in the international business. So we think we should see improving like-for-likes in the travel unit that should drive a re-rating in the shares.